Welcome to Chapter 9. In this chapter, we're going to move away from preparation of annual income tax returns and the calculations associated with that and talk about payroll as well as retirement plans. So, as you probably garnered from your own paychecks, there are instances in which someone will receive money, but that money will come after taxes have been withheld. If someone receives, as your slide says, salaries, fees, bonuses, commissions, vacation pay, the employer is obligated to withhold tax based or from those wages prior to dispersing them to the employee. How does the employer know how much tax to take? Do they guess? What do they base this on? As part of new hire paperwork, employees should be required to complete a Form W-4, and that form is what the employer is going to use to make the withholding as part of the payroll each payroll period. Now, the employee isn't obligated to audit the employee's form. They're allowed to just take what the employee reports, and as long as the employer withholds consistent with the W-4, the employer's in good shape. Now, sometimes employees try and manipulate this number so that they get more money back in their pay each week, or they get a huge refund for themselves. More often, employees will forget about other sources of income that they have separate and apart from this job when they're calculating how much they want this employer to withhold. So the form does allow the multiple jobs worksheet, and if the employee doesn't go as far as to fill out the multiple jobs worksheet, that's not the employer's fault, but probably the employer is not going to withhold correctly, and the employee may end up with a tax bill at the end of the year and then will be shocked and angry with the employer. So these are can be challenging situations, but if you've got an employee that's working more than $1,500 annually at a second job, it's really important that they complete that multiple job worksheet. But if they don't, as the employer, it's not your problem. However, if you're the employee, it will become your problem if you don't take that extra step. Now, if you are the employee and you decide that you're going to engage in a little monkey business in completing this W-4 just so you can get a little more money back in your pay each pay period, the IRS is wise to you. There are potentially two penalties that, well, more than two potentially, but it will depend on the level of monkey business that you have engaged in. If what you've done is kind of pushed the envelope and gone into the, we won't even say into the gray area, beyond the gray area, but beyond what a reasonable person would have considered an appropriate withholding allowance to claim, then it's just a $500 penalty. But you will also likely owe at the end of the year, so then you will have underpayment penalties when you go to file your taxes as well. However, if you willfully file a fraudulent W-4, you can also get an additional $1,000 in penalties and go to jail or both. There are a couple of ways, and frankly, most employers that are doing withholding are going to be using commercial software to do this. But the two common ways to calculate payroll withholding is the percentage method and the wage bracket method. And again, the most commonly what happens is the employer is going to use some sort of commercial software, and a software company has loaded the tax tables into the software already so that the software recognizes, okay, this is a single employee or this is a married employee and there are this many allowances, and then it's also based on the frequency of the pay period. So is this weekly, bi-weekly, semi-monthly, and So then the appropriate withholding is calculated based on all of those factors. If you're doing it by hand, then there's a circular E, which will set out all of this information for you. So uh, the payroll is based on total taxable wages. So there may be some pay that is not subject to tax. If the employee has health insurance taken out pre-tax, for example, then you're wanting to use the what is called sort of the federal gross as opposed to the true gross when you're calculating the withholding. Often, people who are retired will receive pension or income from a 401k or an IRA at some point down the road. Most often, that money was put into that account pre-tax. And now when these people are in their retirement and they want to draw on this account, this is where they pay the piper, as they say, and tax is paid on those retirement funds. The retiree will be required to complete a Form W-4P, and that will then tell the pension company how much to withhold based on whatever allowances the retiree is claiming. Well, many retirees may be taking their retirement in monthly payments. There are certainly instances where they will want to dip into their retirement and take out large chunks. Maybe they're going to pay off their house, or maybe they're going to take a trip around the world. Whatever it is, it's their money, they earned it. However, if these are sort of one-time chunks that are taken out, then the withholding is either a flat 10 or 20% depending on the kind of retirement fund. So that is, again, separate and apart from the monthly payments. Tips. Back in the day, and I have hoisted my share of food trays in restaurants in my day, and I think that the industry has changed pretty substantially since I last worked in it. I got a lot of tips in cash early on. And I would say, at least based on my own dining habits as well as what I see when I dine out, it appears as though few people are now paying in cash and are more likely to charge on credit cards. So while wait staff during this sort of cash era could often not report all of their tips and not get caught, that time is probably, by the wayside at this point, because most people are putting the tips right on the credit card slips, and those tips may end up not in the waitstaff's pocket at the end of the night, but also as part of the paycheck. And so withholding is done based on that. However, if you do have an instance where you've got lots of tipped employees and no real way to track, the IRS got wise to the fact that employees weren't reporting all their tips, so employees were then required to claim those. And for a large food and beverage place, basically the employees got to look at what is being claimed and by the individual wait staff, and it's got to be at least 8% of sales. If the wait staff is claiming less than 8% of sales, then the employee has to at least bring that up. So let's say the employee is only claiming 6% of their tips. The restaurant's going to say, sorry, we're going to assume that at least 8% of your sales was tip income, and they're going to tax your hourly part of your paycheck or your other tips, should they come through your paycheck, to make up that difference. There are instances where institutions may have to collect what's called backup withholding. And again, this is often due to probably some sort of monkey business on the part of the taxpayer. Either they provided a fake social security number, or they just didn't provide one at all or something like that. And so this flat 24% would be interest and dividends, and that is under the theory that, at least if they collect 24% up front, that probably they're going to get most of the tax that was owed on that money. Estimated payments. You will see estimated payments come around generally with self-employed folks. If you don't have an employer that is taking money out of your paycheck every pay period, but instead are engaged in business as an independent contractor or a sole proprietor, you have to quarterly pay estimated payments based on what it appears that you will owe annually, and you break it up into four chunks, and it goes 4 times a year to the Internal Revenue Service. Now you say to yourself, well, how do I know how much I'm going to earn? And we're in the fourth quarter, or excuse me, the first quarter. How do I know at the beginning of the year how much I should have to send for my estimated tax payments? And the IRS gives you some guidance. And so basically, if you 90% of the current year's tax, or 100% of what you owed last year, you can also annualize it, or basically do it on an annualized basis each quarter, so you can break it up over 4 quarters evenly. Or if you are a seasonal type person and a big chunk of your money is made during, I don't know, summer or something like that, then they will accept smaller payments during what would be your low season, and then you make your bigger payment when you have the income from your higher season. And while I mentioned that this is most often for sole proprietors and independent contractors, if you've got somebody with a large amount of investment income and maybe it's coming from lots of different sources, it's certainly good to be making estimated tax payments, because if you don't, you will get a penalty for underpayment. The 4 days during the year where the estimated tax payments are due are here. So April 15th, June 15th, September 15th, and then the last quarter payment is actually due in the first quarter of the following year on January 15th. And now we get to FICA. And I gotta move this down just a hair. Okay. FICA is a combination of 2 different taxes. It is Social Security and it's Medicare, and that is how those 2 systems are currently funded. The money that is being withheld from your paycheck for Social Security is not being put in a nice little savings account for you to get at some later point. And in fact, if you want to be a little disturbed, order your Social Security statement. And my guess is if you are at least my age, and I won't tell you what that is, or younger, there will be a big disclaimer on the bottom of your Social Security statement that will tell you that while you are entitled theoretically to receive a certain amount, that they're not going to be able to have that much money there for you, and that really you'll get a lesser amount. And the first time I ordered my Social Security statement and saw that, it caused me to really reconsider the fact that I was calculating Social Security into my retirement plans really to any degree, because if Congress decides not to fully fund Social Security, people who are currently paying into it won't be able to fully take advantage of that the way that current retirees have been able to do. So Social Security is made up of 2 halves, half from the employer, half from the employee, and it's 6.2% for each, for a total of 12.4%. Medicare is also that 2-part. It's a total of 2.9%, half from the employee, half from the employer. The difference in the way that the withholding is done between these 2 funds is that there is an annual cap on Social Security, and once you reach that cap, you don't have to pay it anymore. So that's actually not a bad deal. As long as you hit the cap, then you get an extra 6.2% in your paycheck for the rest of that year. Kind of a nice little, bump at the end of the year. There is no cap for Medicare. So Medicare gets paid on all wages in any amount. But the Social Security, and I pasted some tables in just so you could get a sense of how the cap changes over time. And so it goes up pretty precipitously. So if you're kind of at the top end of these, you might not get to avail yourself of much of the Social Security free wages, especially because they raise them so much every year. And so we'll do a little example here. We've got Shannon that's employed at Berkeley Solar Tech. She's got a 2019 annual salary of $135,000. What is her FICA tax for the current year? How much does her employer pay? So we look back and we see $132,900 is the cap for 2019. She makes, let's see, 2,100 over the cap, if I calculated that correctly. And so her Social Security is she pays it on the first 132,900 at 6.2%, but the entire thing is subject to the Medicare tax. So her total FICA, again, both parts, is $10,197.30 for 2019. Now, what happens if you have multiple jobs and between all of your jobs you earn more than that Social Security cap? Well, each individual employer isn't going to know that how much you've earned at your other jobs. So it's quite possible that they will withhold collectively among all your employers more than the cap. And if that's the case, you do get a refund of that at the end of the year when you do your taxes. That all gets calculated and the overage gets refunded to you. So the employer is going to make all these withholdings. What does the employer do with them? And I've sort of covered up part of your slide here. We'll put me over here. This is called the Federal Tax Deposit System. And it used to really be a deposit. And I actually managed to dig through my drawers, benefit of doing this from my private office, and I found a tax deposit coupon booklet. And it used to be that you would get these in the mail from your business, and this is pre-printed with my office and employer identification number on it. And it had little bubbles, and you probably can't see it, but for whatever type of tax I was remitting, I would fill in the little bubble and then the quarter, and I would drive this to my friendly local federally insured depository institution, otherwise known as my bank, and I would hand them the deposit. And as a federal depository institution, my bank would take it and they would remit it to the government. That's all changed now. Everything is done electronically, and so yeah, no more coupon books. And frankly, I'm a little surprised that I actually still had this kicking around. I guess I'm more of a pack rat than I thought. So how often do these deposits have to be made? And the answer is that it really depends on the size of the employer's total payroll. If the employer has taxes of $50,000 or less, then the deposit is monthly. They have to do it semi-weekly if it's $50 or $50,000 or more. And then if the withholding and FICA is $100,000 or more at any point during the year, there's a 1-day deposit rule. So they don't want you hanging on to their money as the employer. They want to get that pretty quickly. And this, as soon as the money is withheld from the employee's paychecks, it should be placed in a segregated account, totally separate from any other operating funds of the employer, so that there is no risk that that money will be used for any other purpose other than when deposit day rolls around and that money gets remitted. And again, because it's electronic, I should say, it comes by electronic funds transfer right out of the checking account that you register with the IRS. On a quarterly basis, employers are then obligated to file Form 941 with the Internal Revenue Service, and that is the quarterly payroll tax report return, and that tells how much withholding, what the total wages were, and the number at the bottom that is money owed should match the amount of money that was deposited. If there is money that is left over that wasn't deposited that needs to get sent, then that can go with the return at that point, but there's probably going to be a penalty for that unless there's a good reason. If you are a small employer, this depositing can be kind of a hassle for small amounts. And so what the Internal Revenue Service says is, we're not going to overly burden small employers. So if your total payroll obligation from a withholding perspective per quarter, if whatever you're going to have to remit for withholding is $2,500 or less, or I should say less than $2,500, you can skip the periodic payments during the quarter and make the full payment at the time that you file the 941 return each quarter. So it does save a little bit of bookkeeping for the small employer. I'm going to stop here and move on to the next video for more reporting requirements of employers.